On July 23rd, the reporter the Federal Reserve uses to tell the market what it is about to do published a sentence he has almost never had to write. He said he didn't know. His name is Nick Timiraos. He writes for the Wall Street Journal. And for most of the last decade, when the Fed wanted to do something the market wasn't expecting, this is the man they told first. Not to do him a favor, to keep the market from breaking when the announcement landed. I went back and read what he actually filed. He called this week's meeting one of the most uncertain in years. He called it a close call. He wrote that the Fed appears closely divided. And then the line that stopped me. He wrote that the new chairman has given no indication which way he is leaning. Now here's the part almost nobody has connected. There is a reason he wasn't told. It is not a mystery, and it is not a leak that failed. The machine that tells him was deliberately taken apart, in public, by the man who now runs the Federal Reserve. And one analyst has already put a price tag on what that costs you. Roughly a quarter of a percentage point. On your borrowing. Permanently. Tomorrow at 11 o'clock my time, 2 o'clock Eastern, that same chairman sets the interest rate for the United States. And for the first time in 15 years, nobody outside that room has any idea what he's going to say. I want to show you why they turned the warning light off, and what it is they turned it off directly in front of. Let's start with the thing that got deleted, because most people have never heard it named. It's called forward guidance. For 15 years, the Federal Reserve told you in advance what it was probably going to do. Think of it like the yellow light at an intersection. It doesn't move your car, it doesn't change the speed limit, it gives you 3 seconds to decide. 3 seconds of warning before the number that prices your mortgage, your savings, and every bond you own gets changed. Now watch what happened on June 17th of this year. Kevin Warsh, sworn in as Fed chairman on May 22nd, replacing Jerome Powell, held his first press conference. And the statement the Fed released that day came in at 132 words. In April, that same statement was 341 words. They deleted 209 words. Every hint about what comes next. Gone. And the market noticed within the hour. The 10-year Treasury yield jumped from 4.43 to 4.49. The S&P 500 fell 1.2% that day. That's what a yellow light being unplugged looks like in real numbers. George Perks is a strategist at Bespoke Investment Group. His read on forward guidance is that it served to suppress market swings and anchor market expectations, and that anchoring was worth, in his estimate, about a quarter of a percentage point lower on borrowing costs for consumers and businesses. A quarter point. That's what the warning light was worth. 17 years of practice ended by one man in one meeting with no vote taken anywhere and no law passed. Now let me be straight with you about who actually pays that quarter point, because a lot of people get this wrong, and I'm not going to be one of them. If you have a 30-year fixed mortgage, your payment does not change. Not tomorrow, not in September, not ever. Around 90% of American mortgages are fixed. That is the entire point of a fixed rate loan. Anybody telling you the Fed can raise your fixed payment is either confused or selling something. Here's who does pay. A home equity line floats with the prime rate and moves within a billing cycle. A credit card balance moves too, and you're already paying. The average card rate is above 22%. Anyone who needs to buy a house, or sell one and buy another. Anyone with an adjustable loan resetting. And then, the one that matters most for somebody who spent 40 years being careful. The bonds you own reprice down. Every bond fund, every ladder, every target date fund with a fixed income sleeve inside it. Rates up, price of the bond you already hold down. That's not an opinion, it's arithmetic, and it happens whether or not you open the statement. So no, they cannot touch your fixed mortgage payment. But here's the thing I want you to sit with, because it's the real theft, and it's hiding in plain sight. Your payment is fixed. The dollar you pay it with is not. Nobody can change your mortgage payment. Everybody can change what that payment is worth. Your groceries aren't fixed. Your insurance isn't fixed. Your property tax isn't fixed. You locked the number, and they kept the ruler. That fixed rate mortgage is probably the only contract in your entire life with a schedule that nobody can rewrite on you. That's exactly why you love it. That's why you'd rather die in that house than give up a 3% note. Hold that thought, because there is exactly one asset on earth built on that same principle, a schedule nobody can rewrite, and it isn't a loan. It's Bitcoin. And by the end of this, you're going to see why those two things are the same idea pointed at different problems. Before I show you what the silence is being turned off in front of, I built a free dashboard that tracks the 6 numbers that actually decide what your money is worth, including the live 30-year rate and the Fed funds rate side by side. It's the same screen I check every morning before I write. I'll tell you where it lives in a few minutes, because the next part explains exactly why those two numbers stopped moving together. There's a phrase this chairman keeps returning to, and it is the title of his own published work at the Hoover Institution. Inflation is a choice. In his written statement to Congress on July 14th, he put it plainly. Underlying inflation over longer time horizons is determined largely by monetary policy. He said, high inflation has been an undue burden on American households and businesses. He said the Fed has no tolerance for persistently elevated inflation. Translate that. Inflation is not weather. It is not supply chains. It is not a war, or a virus, or a boat stuck in a canal. It is something the Federal Reserve does. That is a sitting Fed chairman throwing out the entire transitory, not our fault defense that his predecessors leaned on for 4 years. And in saying it, he walked into a trap of his own making. If inflation is a choice, then tolerating 3.5% inflation right now is a choice he is making, on purpose, today. He cannot call it a choice and then sit still forever without owning the choice. And I don't think that pressure resolves tomorrow. I think it resolves in September, where the market is currently pricing roughly an 80% chance of a rate increase. The odds of a hike at tomorrow's meeting went from 12% to 40% in 11 days. And the jobless claims number that did most of that work was 187,000, the lowest reading since 1969. Which brings us to what all this silence is standing in front of. Here's the situation into which the Federal Reserve has decided to stop explaining itself. Start with the simplest measure of whether a stock market is expensive. Warren Buffett once called it probably the best single measure: the total value of the stock market divided by the size of the actual economy. Right now, that measure sits more than 2 standard deviations above its long-term trend. You spend about 95% of your time inside 2 standard deviations. Outside, it is the tail, and historically, you don't stay there long. Second, the crack has already started, somewhere most Americans never look: South Korea. In June, the Korean market plunged 10% in an AI-driven sell-off that dragged Wall Street with it. In early July, it fell another 6, then another 8 after Meta's AI announcement set off a global chip sell-off. Korea is where the chips actually get made. It isn't a side market, it's the front of the machine. Fortune put it plainly on July 19th. Korea's AI-heavy market now sets the tone for global stocks. When the front of the machine shakes, that's the tremor that arrives before the thing you own moves. And third, on top of all of it, a Fed where a governor is publicly mocking patience, where the market prices roughly 80% odds of a rate increase by September, and where the chairman just switched off the 3 seconds of warning. Those clocks are set by different people who don't talk to each other. Rates, chip stocks, valuation, and they are all pointed at the same 60-day window. And I want to be honest with you about something, because I'd rather tell you the uncomfortable part myself than have you find it out later.
Bitcoin does not escape that window. It didn't in March of 2020, and it hasn't this time. Bitcoin is down roughly 50% from its October high, right alongside the chip sell off. When the whole market reaches for cash, everything gets sold, and Bitcoin gets sold too. Anyone who tells you Bitcoin is a hedge against a liquidity event in the same week the liquidity event happens is not being straight with you. Bitcoin is not the umbrella. Bitcoin is what's still standing after the storm passes. And the reason why is the entire back half of this video. Your savings are sitting inside that window right now. And the thing that would normally warn you has been unplugged. But none of that is the part that actually changed my mind this week. This next piece is. While everyone has been staring at the interest rate, the United States government has quietly become a shareholder. Not a regulator, not a lender, an owner. Fortune published the accounting 2 days ago, on July 26th. Since January of 2025, the federal government has taken roughly $26.7 billion across 30 equity or quasi-equity deals in American companies. The biggest one? The government owns 9.9% of Intel. Bought through the Commerce Department in August of 2025, 433 million shares at $20.47 each. That position is now worth somewhere around $42 billion, a gain of about $33 billion. Now here are the three details that made me stop and read it twice. 1. These stakes are scattered across at least 4 different agencies, 17 at Commerce, 7 at Defense, 6 at the Development Finance Corporation, 2 at Energy, and, in Fortune's words, there is no consolidated ledger of the government's holdings. The most complete public accounting of what your government owns comes from a think tank, the Council on Foreign Relations, not from the government. 2. Of those 4 agencies, only one, the Development Finance Corporation, has explicit authorization from Congress to hold equity at all. And that authority was written in 2018 for international development projects overseas. 3. And this is the one. Federal budget rules treat buying equity as money going out, with, quote, very little mechanism for recognizing what comes back. Which means Intel's $33 billion gain appears nowhere in the federal budget. The purchase shows up, the profit doesn't. And the administration is not hiding what this is. Kevin Hassett, who directs the National Economic Council, described these stakes as a down payment on a sovereign wealth fund. A sovereign wealth fund. That's a government that owns the economy's productive assets directly. Now, somebody is going to say, we did this in 2008. It was called TARP. TARP was 700 billion, far bigger. But TARP had a special inspector general filing quarterly reports, a congressional oversight panel, and GAO audits. Congress built a watchtower before it wrote the check. This has none of that. None. So it isn't unprecedented in size, it's unprecedented in oversight. And a senior fellow at the Council on Foreign Relations, Jonathan Hillman, put the marker down. The deals that have been announced to date are only the tip of the iceberg. This is exactly why I built the Macro Command Center at timtalksfinance.com. It's free, and it puts the 6 numbers that decide what your savings are worth on one screen. So you're reading the same instruments I am instead of waiting for somebody to tell you what happened. Because the next thing I'm going to show you is why the response to all of this is not a choice anybody gets to make. Here's where people's intuition usually goes. And it's close, but one word off, and that one word is the whole game. The intuition goes, if the Fed wants to kill inflation, let the market fall. People feel poorer, they spend less, prices stop rising. Cure the high prices with high prices. That is genuinely how part of the machine works. It has a name, the Financial Conditions Channel, and it's in the textbooks. But there's a distinction that matters enormously, and almost nobody makes it. Disinflation means prices are still rising, just slower. That is the goal. Asset deflation means stocks and bonds fall. That is the tool. Deflation, actual falling consumer prices, is the thing they cannot allow. Ever. And I can show you exactly why in one number. Total federal debt is 39 trillion $676 billion. That's from the Treasury's own daily statement, to the penny. Think about what deflation does to a borrower. Prices fall. Your debt does not. Every dollar you need to pay it with just got harder to get. Deflation makes the real weight of a debt grow. Now apply that to 39.7 trillion. A government carrying that much debt cannot survive falling prices. It structurally requires inflation to grind the pile down. Inflation isn't a bug in a system this indebted, it's the drainage. So follow the sequence. They tighten. Asset prices fall, allowed, that's the tool working. Then at some point, the fall stops being a tool and starts breaking something. We've watched that movie 3 times in 7 years. The repo market seizing in 2019, March of 2020, the bank rescue in March of 2023. Every single time, they reversed. Fast. And here's the thing I want you to hear clearly. That reversal is not a decision. It's arithmetic. At 39.7 trillion, the debt math does not leave another move on the board. So a deflationary Christmas isn't the ending, it's the trigger. The crash is permitted, the deflation is not. And the response to the deflation is the printer, which is the same printer that has been quietly taking a percentage out of your savings for your entire adult life. Now let me be careful, because this is where a lot of people go off a cliff, and I'm not taking you there. I am not telling you anybody planned this. I have no evidence of that, and neither does anyone else. I'm telling you the machine has a shape. And the shape means that every crisis ends with somebody owning more of the productive economy than they did before. And for the first time in American history, that somebody includes the federal government, holding 9.9% of Intel, with no consolidated ledger of the rest. That's not a prediction, that's a description. And once you can see the shape of that machine, one question ends up mattering more than every other question in finance. And it's the question this entire channel exists to answer. Which asset has no issuer? That's it. That's the whole thing. Every single item in that chain we just walked required somebody who could make more of something. More dollars, that's the Fed. More debt, that's the Treasury. More shares, that's a company diluting you. More stakes in more companies, that's the Commerce Department with no ledger. Everything they are about to move onto digital rails, real estate, treasuries, funds, stablecoins, every one of those tokens still has a man behind it who can make more of it. A tokenized bond has an issuer. A tokenized house has a registry. A stablecoin has a company. A central bank digital currency has a central bank. Every exit they are building for you has an owner. There is exactly one asset that doesn't. Bitcoin. 21 million. Fixed. Forever. No servers, only a protocol. And I don't want you to take that as a slogan. So let me show you the mechanism. The way we've done everything else in this video. Bitcoin has no chairman. There is no Kevin Warsh of Bitcoin, who arrives in May and deletes 209 words in June. There is no forward guidance to switch off, because there is nothing to guide. The supply schedule was published in 2008 and has done exactly what it said it would every 10 minutes since this year. Through 4 crashes, 2 bank crises, a pandemic, and a war. Bitcoin has no commerce department. Nobody can take a 9.9% stake in the protocol because the protocol doesn't issue shares. There is no share to buy. Bitcoin has no treasury. Nobody can add a trillion to the pile with a keystroke because there is no keystroke that produces more Bitcoin than the schedule allows. And this is the sentence I keep coming back to all week. The United States government owns 9.9% of Intel. It can never own 9.9% of Bitcoin's issuance schedule. It can buy Bitcoin. Anyone can buy Bitcoin. Governments, banks, you. But buying it doesn't get you a vote on how much more of it exists. There is no vote. There is nobody to lobby. There is no table to sit at. That is not a feature somebody added to Bitcoin. It's the reason the thing was built. That is the entire argument. That's the whole channel. Everything else is evidence. And now think back to your mortgage. That 30-year fixed rate is the one contract in your life with a schedule nobody can rewrite. That is exactly why you protect it. You already understand this asset class. You've owned one your whole life. Bitcoin is the same property, a fixed schedule nobody can change, applied to the money itself instead of the loan. So let's do the honest math, and I mean honest in both directions. Bitcoin peaked on October 6th of 2025 at $126,198. It trades today around 65,000, down roughly half. Bitcoin has moved in a rough 4-year rhythm its whole life, anchored to the halving when new supply gets cut in half. The last one was April of 2024. Every cycle has topped about 18 months after a halving and bottomed 12 to 14 months after the top. April 2024 plus 18 months is October 2025. That's the top we got. Plus 12 months is October of 2026, roughly 90 days from now. I'm not the only one with that date. Michael Turpin, who has been in this market since the beginning, published in late June that he expects capitulation in early October, with a bottom somewhere between $39,000 and $55,000. Now the upside, and I'm going to show you my work so you can check it rather than trust me. Each cycle top has been a multiple of the last one. 2013 to 2017 was 17 times. 2017 to 2021 was 3.5 times. 2021 to 2025 was 1.83 times. If the next top is 1.8 times this one, that's about $227,000. And here is the honest problem with that number, which you will not hear from most people quoting it. Look at the pattern again. 17, then 3.5, then 1.83. Those multiples are shrinking every single cycle. If the shrinking continues, the next one should be less than 1.83. At 1.5 times, you get 189,000. At 1.3 times, you get 164,000. So 227,000 assumes the shrinking stops. Maybe it does. I don't know. And neither does anyone selling you that number. There's a second honest problem. There is a serious argument that the 4-year cycle is already broken, that the exchange-traded funds and the institutions have changed the rhythm permanently. And there's evidence the cycle is at minimum getting shallower. The 2013 high took 3.1 years to recover. The 2017 high took 3.0. The 2021 high took only 2.3. Two scenarios. Scenario 1. The cycle roughly holds. Bitcoin bottoms in the 39 to 55,000 range this fall, in maximum fear, while the market you were told was safe deals with a stretched valuation and a chip sell-off. From a 50,000 entry to a 190,000 top, that's under 4 times over about 3 years. Scenario 2. The cycle is broken. 65,000 was close to the low, and there's no capitulation coming. In that case, the man sitting entirely in cash waiting on October gets nothing but the erosion. I don't know which one happens. Neither does anyone else. There are no certainties, only probabilities. But here's the part I'd want somebody to tell me. Cash wins the crash. Cash loses the response. If everything in this video is roughly right, there's a window where holding cash is exactly correct. And then there's the reversal, the one that's arithmetic rather than choice. And on the other side of it, cash is the thing being quietly taken from. So cash isn't a destination, it's a ticket. If you're holding it, hold it knowing what you're holding it for, and knowing there's a date it stops being good for it. And if you never get the fill you wanted, the entry you can get today is still a fraction of where 2 of those 3 scenarios end up. 21 million doesn't require you to time anything. That's the difference between a trade and an exit. 3 signals to watch, all specific, all checkable. Signal 1. Tomorrow at 2 Eastern, count the descents, and note which direction they go. Under a chairman who deleted forward guidance,
The descents are the forward guidance. It's the only channel left. Signal 2. Watch Korea, not Wall Street. Fortune says Korea now sets the tone for global stocks, and it's where the chips are actually made. If Seoul keeps breaking, that tremor arrives here. Signal 3. Watch the Council on Foreign Relations deal tracker, because your government doesn't publish one. If that count moves past 30 deals, you're watching the ownership transfer happen in real time, on a spreadsheet maintained by a think tank. One last thing. Tomorrow, a man who believes inflation is a choice will make a choice, and he will not explain it the way his predecessors did. However that vote goes, it does not change a single line of code in the one asset that has no issuer. 21 million. Fixed. Forever. That number was true before the meeting. It'll be true after it. And it is the only number in this entire video that no one in that room can vote on. Everything I make is at timtalksfinance.com. The macro command center is free, and it's where I keep the 6 numbers this video was built on, so you can watch them move yourself instead of waiting for the news to tell you what already happened. I'll see you tomorrow, right after they vote.